We have all felt that sting of regret. You open your phone, look at the market, and realize you missed it again. Recently, Dell's stock shot up 30% in a single day, and it happens constantly. Look at Intel. In 2026, it climbed over 190%, turning early investments into fortunes, while most people watched from the sidelines. When these massive moves happen, retail investors usually point to a single headline. They see a political endorsement or a passing comment from the Trump administration and assume that headline is the sole reason the stock took off. This creates a dangerous loop. You see the news everywhere, the fear of missing out takes over, and you hit buy right as the momentum dies, leaving you holding the bag at the absolute peak. Here is the reality. If a stock has already spiked 30%, and you are only now asking if you should jump in, you have already lost the trade. Real market wealth comes from spotting the shift before the rest of the world catches on. To do that, you need to ignore the daily news cycle and look for 5 specific financial signals that quietly appear right before a major breakout. Let's look closely at Dell. The true catalyst for their massive run was not a passing political comment. It was an earnings report that completely reset Wall Street's expectations. This chart shows exactly why the market reacted. Dell reported $43.8 billion in total revenue, driven by this towering $16.1 billion spike in AI-optimized server sales, a 757% increase year over year. That brings us to our first signal: identity revaluation. Investors began pricing Dell as a core delivery mechanism for AI infrastructure, moving past its legacy in the low-margin personal computer market. And that ties into the second signal. You have to separate concept stocks from real revenue. Lots of companies talk about artificial intelligence, but Dell validated its new market position with cold, hard cash on the balance sheet. Intel followed a similar path. The market viewed them as a struggling legacy chipmaker until they secured government backing to rebuild domestic manufacturing, supported by 22% growth in their data center and AI segments. The highest conviction trades happen right here. An overlooked legacy company proves it has tapped into a high-growth sector by showing verified rising revenue in its quarterly reports. But a single good quarter is not enough to justify a massive surge. Institutional investors demand deep future visibility before they are willing to pay a premium. That leads us to the third signal, the backlog. This graphic shows the sheer scale of future demand. That solid base is the recognized revenue, but it is instantly overshadowed by a record $51.3 billion backlog of unfilled AI server orders. That backlog guarantees sustained deliveries for multiple quarters ahead. This influx of orders is driven by our fourth signal, capital rotation. In any major tech cycle, the money always starts at layer 1. For AI, that was the central computing chips from companies like Nvidia. Once that first layer gets saturated, capital naturally flows into layer 2 and 3 infrastructure. You cannot run billions of dollars of chips without servers, liquid cooling, and domestic semiconductor fabrication facilities to build them. Finally, we have the fifth signal, valuation recalculation. Your greatest margin of safety exists when the broader market still doubts the company and prices it as a legacy business. If you wait until everyone believes the new story, the stock is already expensive. When a company secures massive future visibility right as institutional capital rotates into its specific sector, the stock is primed for a significant reassessment. Now, a word of caution. While Dell and Intel have the data driving them, their current stock prices reflect a massive amount of optimism. They are no longer cheap. At these elevated levels, sales growth alone is not enough to keep the stock climbing. You have to rigorously scrutinize their gross margins and free cash flow to ensure the actual profitability of the business remains healthy. To find the next opportunity before it runs, apply this strict checklist. First, is the company positioned in a major structural macro cycle? Second, have they turned that story into verified revenue? Third, do they have high backlog visibility securing future quarters? Fourth, is their profit quality actually healthy? And fifth, is the market still underestimating the business? Knowing this checklist is one thing, but executing it is another entirely. When the media noise gets loud and the fear of missing out kicks in, it is incredibly difficult to stay logical and follow a system. That is exactly why we created the Stewardship Finance Academy Free Stock Investment Masterclass. We want to help you trade with clinical, institutional precision instead of reacting to the daily news. We have packaged over 30 years of market experience to teach you exactly how to read these financial cycles, analyze the data, and time your entries. Click the link in the description below to secure your spot. You do not need to catch every single stock to build wealth. You just need the discipline and the right tools to spot a changing growth cycle before the rest of the world even notices.